Good afternoon, everybody. Today is Tuesday, January 26, 2021, and today we thought it'd be important to discuss our outlook for your investment portfolio over the next 24 months, and also why our current holdings appear likely long-term to continue the recent outperformance. We'll also discuss the effect of economic uncertainties in our nation's markets and how our country's economy and the investment markets are most likely to react to these uncertainties based on relevant historical models. We wanted to share this video with you because we deeply care about each and every one of our clients and truly want to eliminate any unnecessary apprehension about your financial future. You know, there's a lot of angst and even fear swirling around the investment markets right now. Hopefully, this discussion will help you understand our very, very different view. Our firm always looks for the most probable outcome in every investment decision or situation. We don't base our investment decisions on wholly unlikely events, and we always look longer term. Remember, we're buying companies, not stocks. However, we also attempt to recognize potential problems when they occur, which allows us to make proper decisions on how we can take a problematic investment or a problematic economic situation and create a positive outcome for your net worth long term. So in our September 23rd, 2020 Facebook Live session, which some of you may have watched, we stated that, quote, "We believe there will be a more anemic economic growth with a Biden presidency, but we also believe our portfolio performance should be exceptional." Folks, that was based on what we own, not on the economy. Those are two different things. We also said on our October 28, 2020 video titled "Do Not Fear, the Road Ahead is Bright," that we believed our portfolio models were actually better suited for a Biden presidency. So let's go back now, let's hindsight it, and let's see how it worked out. Since November 1st, 2020 to January 20th, 2021, our clients' accounts are up 36.59% net of cost, doubling the S&P 500 index returns over the same number of days of 17.79 and the Dow Jones return of 17.68. Further, since our market low call on March 23rd, 2020 to January 20th, 2021, our client accounts are up 87.09% net of all costs, compared to the S&P index and Dow returns of 72.16 and 67.75% respectively. Taking a look now at chart 1, we show this graphically. You can see the inherent advantages of what we've done over these periods of time. More importantly, you can see that we projected this event. We did that based on fundamental analysis and based on economic history. So what drove our significant outperformance? We think it's our firm's investment patience. And like everything else in life, folks, you have to be patient. We think it's due to our firm's concentrated, predictive, and active, not passive, asset management style. In our view, long-term investment success has always involved calculated investment selection, patient investment, staying true to an investment discipline over market cycles, in other words, not changing horses in midstream, and an understanding that temporary declines, like the one that occurred when our country's leadership actually created a near economic collapse with business shutdowns, understanding that those will end as soon as politicians decide to open businesses back up. In other words, if you choose to close the door to the economy, to business, stocks will always decline. But when you open up, things are likely to go to the same or higher pricing level than there were previously. This is the same historical pattern for all temporary declines, or what I call glitch events. In the COVID-19 crisis, which I believe is a glitch event, our firm played smart, ignored the useless fear-based media and brokerage firm chatter, and relied on long-term lessons through economic history and our own unique knowledge of the markets. And the result? We've regrown your capital. Remember, our firm does not sell in glitch events because historically they are repeatedly self-correcting. We will sell in recessions, which do not tend to be V-shaped quick recoveries like the glitch event. The best example of this was our action in the recent 2008 to 2009 recession, one of the worst our country's ever had, when we fled to cash with approximately 75% of our clients' monies, avoiding a very large part of the 2008 decline. We then reinvested on the day of the market's 2009 low, a day we called in a letter to all of our clients, and provided on average our clients' net return of 46.82% in the year of 2009, more than twice the S&P 500 return. So how do you know your financial future is not going to be negatively impacted long-term by political policies? Here's how we know. Everywhere on this planet, liberalism, socialism, or communism has been practiced, it has failed. Every single time. Many folks are fearful about our nation's future and the progress of their investment holdings. But an important thing to remember is that our firm has very successfully dealt with this situation many times. President Obama was far more charismatic, energetic, and able than President Biden. With the Biden family's legal issues, they're very likely to arise from the special counsel Durham's report. His office's power, the office of the presidency, is likely to fade quickly. We also have an evenly split Congress, which will make it very difficult to pursue his liberal agenda. If you listen to the press, you heard that bills would just fly through. No chance. Our nation's republic will not become a socialist utopia, mainly because there are no socialist utopias. They don't exist, AOC. But socialist banana republic hellholes do exist. I've seen a few of them. President Biden also has to deal with the thinnest congressional majority in decades. It's going to be very hard to get things through the House, and I believe we can effectively stop him on the conservative side of the aisle in the Senate. That's going to slow and impair any agenda, but most particularly things like the Green New Deal. Some problematic changes will occur and have occurred through executive orders of the President. But we believe Senator McConnell, as the Senate Minority Leader, will be highly successful in blocking any significant problematic House legislation. Conservatives hold the majority, remember, of our state legislatures and governorships, as well as hundreds of judges appointed to the federal courts over the past 4 years. Those courts can handle litigation that arises from potential unconstitutional laws that may filter through. All in all, conservatives in our country have an edge, an actual edge, in national and state governance, something that we do tend to forget. Emotion is poison to investor returns because it creates needless worry. And I always think about that because that creates sleepless nights. This is the most important thing I want to talk about in this video. For many people, I know it can be challenging to keep your emotions in check during the ebbs and flows of the market. It's understandably stressful when you feel the security of your investments is threatened. But don't allow a volatile market to cause you too much distress. Your worry will not change events or your account values, but it can sabotage your results by causing unwise investment changes. Fear, all fear, especially investment fear, is a liar. I want to give you a quick story. I've had many times in over 40 years of aviation where I've had very, very serious aircraft emergencies. And, some of those were in the B-52, where as a pilot I had 5 other guys depending on me. And some of them were in my own airplane, lost an engine with my family, and then in the dark landed in an unlit field in Georgia in the middle of the night. And for the passengers in those commercial airplanes, those B-52s, those civilian airplanes, that could be unsettling. For a professional pilot, it's not. You know exactly what to do. You've hired us to fly this airplane to your destination, and we're going to get you there safely and on time. When it comes to investing, you must take emotions out of the picture. That's one element our firm is paid by you to do. And it's also an element where we excel. I always suggest that our clients, when they're having doubtful times, look at our third-party Morningstar computed returns. Net of costs, it's all clients, all accounts. It's in our introductory information, which is very important to look at because it'll keep you on track. You'll see that our record in providing investment excellence is very clear. You know, that's why we choose to publicize it. How many other firms publicize their performance? Most investment advisors and brokerage firms don't. If you want to assess anyone or any company's future success, you have to begin by looking at their past. And remember that historically, no matter what disaster has occurred, the equity market, 100% of the time, not 99.9, has always rebounded. Take a look at this Ibbotson chart, which shows the growth of a dollar invested back in 1926 in different investment instruments. First, you've got small cap stocks at 11.9% return. Then large cap stocks, 10.2, government bonds, 5.5, treasury bills, 3.3, and inflation, 2.9. Over very, very long periods of time, those numbers are remarkably consistent. That $1 invested in small company stocks grew to $39,381 between 1926 and 2019. If invested in large capitalization stocks, like the S&P 500, it would have grown to $9,244. If invested in government treasury bonds, it would have grown to $159. This really makes you think about where risk truly lies in the market. Does risk lie in this flight to safety and the attractiveness of fear-based investing? Or does it lie in trusting a capitalist economy to do its own checks and balances and to climb that wall of worry that the market has always climbed? Chart 2 shows you how SFA has persevered. These are our actual numbers, performance numbers of all accounts, net of all costs. We show $250,000 invested at the first of 2009. And then the relative growth we've achieved vis-a-vis the Dow Jones Industrial, Dalbar, which that's the annual study that is done by Dalbar Inc., very large econometric company that takes a look at investor returns on an annual basis. That would be your neighbor next door or your brother, your girlfriend. And then we also throw in there the corporate and government 1 to 3 year index and the Dow Jones Precious Metal Index. These numbers are striking. And again, what they show is our firm has tended to exceed almost all indices over a very long period of time, as assessed by Morningstar after all expenses. Even stacked against legendary investor Warren Buffett, our firm's Morningstar computed returns have maintained an edge net of client cost. And take a look at this chart and we'll show that. We go back again to the inception of our Morningstar process where they assess us in 2009, and we look at all accounts. This is growth and income, and stable value type accounts all together, net of all cost, and the performance we've had year to year. And again, you see a large and a marked difference between our returns and Mr. Buffett's, who is frequently referred to not only as the world's greatest investor, but a great stock picker. We've maintained an edge, net of all client costs. $100,000 invested with our firm in 2009 by the beginning of 2020 would have grown to $344,993. Berkshire Hathaway's results, $316,542. We've maintained an edge net of all client costs. Taking a long-term historical view of the market can help you align yourself and your investments with the bigger picture. But removing your emotions from your investments is easier said than done, and I think we all know that. As you tune into media every day and even check on your accounts to see how they're doing, remember to step back and think hard about your portfolio's big picture. Doing so can help you to not miss out on major investment gains down the line, to not overreact when we have our normal down days. And folks, there are going to be down days, down quarters, down years. Remember, the charts we're showing you reflect all of that. Market downturns, regardless of what you own in your account, are a normal and an inevitable part of investing money. But long-term equity market returns have, 100% of the time, outweighed short-term losses. Spectrum's unique investment style and our disciplined approach have stood the test of time and been developed for 34 years through both market lows and highs, which has also provided our clients during that time with exceptional investment returns long term. Our firm will always make our investment decisions in a pragmatic manner based on fundamental analysis and economic history, not emotion, providing more certainty for your long-term returns. You know, as my associates and I can tell you in our industry, there's a lot of selling to fear. I almost think people create it intentionally. And the reason is that people listen to fear-based sales. They listen to it even when it hurts them financially long-term. Fear is truly the most destructive emotion in terms of your investment capital. Most other investment and insurance firms really orient their sales towards client fear, and that causes long-term harm to their clients' finances. The equity market's 9 to 10% return we've shown is dramatically proven to reoccur over long term, 100% of the time. Not every year, but long term. You should also know that our client portfolios have tended, over a long period of time, to provide approximately twice the returns the average investor receives in their portfolio, according to Dalbar Inc.'s annual investment studies. And here's a chart that'll show this. Dalbar is an econometric company that we buy data from, and annually they look at individual and corporate investors' returns. So this chart shows Spectrum Financial Alliance's average client return, net of all costs, versus Dalbar's annual returns averaged over the entire period of time that is depicted. If you take a look at the bottom right of the chart, you can see that we more than doubled the dollar return of the average investor as reported by Dalbar's studies. This is a dramatic and sweeping event in someone's financial life because that doubling again equates to a doubling of your retirement income. Marketing to fear, in my opinion, is based on selfish corporate greed. The kind of greed that believes it gets ahead when the client gets behind, that it wins when the product is sold. So great for them. This is something that's bothered me about our industry for a long time. Fear-based marketing has nothing to do with helping people with their financial planning or their financial security. It's used to excuse, in our view, poor investment performance. And I want to point this out as an aside. Those numbers you saw on the Dalbar chart, those are remarkably close to what the Kentucky retirement system has done for years. Half of the market's return. So many excuses, created so many underfunding situations. These things can be corrected. The way this is being done in our industry indicates a lack of understanding of both investment and economic cycles. And long term, it tends to dramatically reduce investor returns. And those aren't just numbers. The reduced portfolio values that then occur in retirement is where real long-term fears should arise. Because if you do end up earning half of our return or a market return, then your ability to produce income from your investments when you're in retirement is also cut in half. So here's a random thought. The economic seeds that were planted by President Trump and his administration in our economy and our regulation have already sprung. And President Biden and his administration can't rip them out by the roots because those roots are just too deep in our economy. So don't fear. We believe we're going to see a continued healthy upside move. Not every day, not every month, probably not every quarter, but it'll be there. And we also believe that our country will be back to the highest growth economy in the world in extremely short order. This pending upside move is going to be driven by way too much government spending, way too much fiscal stimulus that at this point, in our view, it's not necessary, a bipartisan approved infrastructure plan that's going to be well over $1 trillion in all likelihood, and more importantly, a rapid reopening of our nation's economy and an end to COVID by the early to mid second quarter of this year. Things are not only going to be okay, they should be very, very good. Let other people needlessly worry and hang on to their fear. We look up and we look forward to a bright future. God bless you all. I hope everyone's well. Please call or email us if you have any questions over anything we've covered here or otherwise. And if you do have additional funds to invest, now would be a great time. God bless.